But moving on, let's also get in Sumit Jain, Deputy CIO at ASK Investment Managers, to talk about what's happening in terms of markets, his view and his preferences in terms of the sectors. Sumit, good afternoon and welcome to the show. And this is Hiral on the side. The kind of volatility that you're seeing in terms of markets right now is something that I'm sure everyone is tracking. There is uncertainty. Initially, we started off with trade tariffs. I think that's something which is behind us to an extent. And now we are talking about the geopolitical crisis between Indo-Pak. What would your view be from here on? Because overall, not the kind of pressure that we've seen in the previous geopolitical situations. That's not what is happening in the markets right now. And the valuations have not come off to that extent that where we were 3 to 4 months ago. Putting all of this together, your summation of the markets right now.
Hiral, first of all, let me thank you for having me here. See, the way we look at markets is, in general, volatility in markets have actually increased. And the events that we are seeing in the world, markets are also moving from one goalpost to another. So to that extent, really trying to predict each and every short-term news flows in the market possibly may not yield right results over a long period of time. We really believe that we are at a point or juncture in the world where we may see resetting of multiple things. And that effectively means that if one were to look at markets, it has to be from a really long-term perspective. We will see a lot more businesses or a lot different businesses actually will do well over a long period of time. So eye has to be on how businesses would play out over a long period of time rather than trying to predict the reaction of market from a very short-term perspective. No doubt, markets will keep surprising in terms of their behavior from a very, very near-term perspective. And we do not want to really get into how and what markets react there. We'll keep a razor sharp eye on how earnings are playing out, how businesses would play out, what are the trends or changes or shifts that we are seeing in the global supply chains, global economy. And to our mind, that's a better way to approach markets rather than from a very shorter term perspective from one goalpost to another.
Sure, Sumit. This is Harsh also joining in. So therefore, what's relevant and what's irrelevant at this point, if one were to be looking at India specific, how everything in the global geopolitical environment is playing out, what in your opinion, therefore, would be relevant and what would you currently ignore? So just tell us what's relevant at this point.
So what we are trying to do is we are trying to not too much focus on the short-term tariffs, short-term events in the world. So how would necessary or what rate of tariff would one country charge over another? I don't think that's too much of a focus at the current juncture because only time will tell as to where does all those things settle. So we would be closely watching as to how things are playing out there. But one thing that we really believe that will play out over a bit of a medium term is globally supply chains will see bit of a changes or rather large changes there over next few years. What are the areas where India stands to gain? What are the areas where demand curve actually is relatively more inelastic and India has a right to win? So that's the area of focus rather than focusing on the short-term news flows. So that's what we would avoid in terms of our focus, and long-term trends is what would matter.
So Sumit, what would those areas be? What would the areas where India stands to gain be?
We really believe with this changing supply chains, possibly areas like bit higher manufacturing in the country and what all those areas could be. India stands to gain possibly in electronic manufacturing over period. India stands to gain on the pharmaceutical supply chains, whether it is generic, whether it is CDMO, even for example, medical consumables, India can stand to gain in terms of exports there. So those are the areas where we believe when we kind of focus on right business, right management, those would be beneficiaries. So that's the way we are looking at it.
Sumit, how would you put a defense as a sector from the manufacturing perspective, taking into consideration not only the domestic requirement, but also the kind of spends that the European region is extending as a percentage of their GDP, right? What would your view be? Because today as well, or the last 5 trading sessions, defense as a sector has been firing on all engines.
That's right. And globally, we are in an era where possibly defense spend should inch up. Clearly, the opportunity for India's defense manufacturers actually increased dramatically. Not only would the opportunity increase for domestic manufacturing, but it can increase for exports as well. But we have to be mindful of what are the areas where we would see relatively higher defense or relatively better opportunity for Indian defense manufacturers. Right? So to that extent, it has to be relatively more nuanced in terms of where we are focusing on. And we would really believe opportunity exists for domestic and exports both. Just that we need to be very mindful of friendly, non-friendly countries in terms of the opportunity.
Okay. And Sumit, when you're talking of export-oriented sector, when you're talking about manufacturing, but when you talk about IT, a lot of reliance that happens in terms of global markets, right? The commentary that you're hearing from the large cap peers as well as the mid cap peers is the spends which are on the back burner, or there are delays in terms of deal wins as well. What would you advise taking the valuations into consideration? Do you think, in spite of the pain that they are seeing in the near term, the valuations are ripe to look at IT from a long-term perspective?
See, P may be capturing possibly the short-term earnings. Inherently, what's happening in many of these large software services businesses is growth rates have actually become relatively more sedate. Uh, Even over a long period of time, their ability to kind of even show double-digit constant currency growth rates would be very difficult. Not only is or growth rates within these space is relatively more sedate, it comes with global volatility as well. Uh, no, along with that, what's also happening is there are some challenges with respect to how artificial intelligence can have bearing on these businesses. So to that extent, not only is short term a problem with respect to global economic outlook, medium term as well, we believe there are going to be some challenges in terms of how businesses would be delivered because of the changing technological order. And consequently, we don't believe that these businesses can report pretty solid growth over a long period of time. And at best, they are trades rather than compounding opportunities.
Right, Sumit. Sumit, you know, some of the pockets that you highlighted, EMS, pharma, especially CDMO within that, defense, maybe not as constructive there, but some of the pockets that you've highlighted and you've said you should go for quality in some of these pockets are also expensive. They are in no way cheap. How do you rationalize that? Is it only the high growth rate that one needs to look at and ignore maybe some of the risks that are underlying, or you believe that there are very low to no risks?
No, clearly one need to be mindful of what is the valuation that one is paying for these businesses. So it can't be that you are buying these businesses at any prices. But one thing that we really believe in is in a growth-starved world, in a world where volatility has increased, those businesses which actually can report a sustainable superior compounding with a reasonable ROC or reasonable capital efficiency, those businesses should command valuation premium. The only question is, what is that premium that one is ready to pay for these businesses? That's the only question. But we really believe high growth, which is more sustained, more predictable, should command some valuation premium.
Okay, and believe want your view also with regard to insurance and lending, because these are two pockets where there's more or less a consensus buy on the street. would you at all be constructive with regard to these, and what would you say it would stack in terms of your list, in terms of priority? Where would it somewhere fit?
So when you look at lending space in general, we really believe over a long period, we should see almost 11 to 12% or 10 to 12% kind of credit growth. We need to look for businesses where the ability to understand their customer is really high, which allows them to have a very tight control over their asset quality. Not only is asset quality decent in those businesses, their ability to grow relatively faster than the credit growth of the system. These are two very important metrics: growth, capital growth, NPA control over NPA. That backed with what is the ROE that these businesses are delivering should be the focus. So this is a large area. We need to pick and choose what are the kind of businesses that we are buying. We would like to avoid businesses which are just close to about industry credit growth with a very normalized ROE. So focus is clearly on high ROE, high growth.
Overall, Sumit, I mean, I know you're looking at equity, but currently if you're seeing equity versus gold, any view in terms of what's happening with gold? Because usually when you're talking about growth, you're looking at equity markets. When you're talking about opportunity in a crisis situation, you're talking about gold. What would you do in the current situation?
I'll not say this versus that. It is equities and gold.
Then let me change it to how much in gold, how much in equity.
I don't think there is going to be a definite single answer to this because it will be a function of one's own risk appetite, one's own approach to investing. So there isn't one size fit all in terms of their asset allocation. They need to look at what is their perspective, what is their approach. That will determine not only about equities and gold, but about equity, debt, and gold as well.
Sumit, very lastly, how are you pegging India's valuations as compared to the other emerging markets? And do you think there is further opportunity for valuations in India to get reasonable, where investors could get a better entry point? Or is this the best time to start nibbling?
So, see, if you look at valuations in terms of PE, no doubt India's PE stacks up at a premium versus other markets. But what is also relevant is if you look at India's PE, or rather India's index, that has also altered over the last many years. In the past, the India's index had a significantly higher component of low ROC, low growth businesses. That has altered. Today, India's ROC is decent as compared to what it was in the past. So should valuation be higher? Certainly, yes. I really believe in a world, and we just discussed some time back, that in a world where growth rates are average, those businesses which shows promise should command that valuation premium. So if one were to apply the same philosophy to India versus other emerging markets, India is among few markets where growth rates are relatively more certain. At the size at which we are, the kind of growth that we are delivering is pretty decent. I would believe 6.5% kind of growth rate should be sustainable over a long period of time. And if we are able to deliver that with double-digit profit compounding in India, for India incorporate over a length of time with ROCs which are what they are, we should continue to command the valuations that we are at.
Okay. Thanks so much, Sumit, for coming in, speaking with us. It's good chatting and great getting perspective. So thank you.
Thank you.
And we'll let you go on that note.
Thank you.
Time to also slip into a very short break. But